Record, and we are good to go. So we're picking up at where we left off in the types of stock compensation. And the first one is stock options. And stocks are an option, not in cap, option to purchase company stock at a future date at a set price. Usually subject to, sorry, I didn't mean to put that period in there. A vesting period. So they would grant you these options and they would say you can purchase the stock. The price of purchase is usually stock price on the grant date. And the reason that it came about is that back in the day, they wouldn't consider it compensation and the IRS wouldn't tax you on it because you technically didn't get anything yet. If they granted you the option to purchase it at the strike price on that day. Reason being, they didn't give you anything, right? But years later, we said they really did give you something, so you have to price it at fair market value. So journal entry for the stock options, or I should say for stock options. On the grant date, there is no entry. You calculate the expense based on the fair value of the stock option and report it as expense equally over the vesting period. So entry at first year to record the expense. You would debit compensation expense. And you would credit stock options. I'm sorry, paid in capital stock option. Okay, so at exercise, now we're through the vesting period and the employee decides I'm going to go ahead and exercise the stock option. And so at exercise, they're going to have to actually pay cash to buy the shares. So this will be the number of shares times the price, the exercise price. And then you would debit paid in capital, stock options. And this will be for the percentage of options exercised. and you'd credit common stock. And you credit paid in capital for common stock. If the par value is larger than the cash and paid in capital, it would result in a debit to retained earnings. I don't know of any instances where that would happen, but it's possible. If the stock options are allowed to expire, then you would debit paid in capital. Common stock. And you would credit paid in capital. Oh, not common stock, stock options. Sorry. The stock options and then paid in capital expired. Good. Okay. So now we have restricted stock. This is a grant of stock, usually at the current stock price. That has a vesting period. So now I'm actually giving them something that has a value. Even though technically it's the same value as what the market is, if I sell it, I should get the market price on the stock. So I'm being given something that is valuable. And so the journal entry to record, and this is the only one that you record at the grant date, is you would debit unearned compensation. And you would credit common stock par value times the shares. And then you would credit paid in capital common stock. Okay, so at the end of the year, when the comp is earned, so this means that they vested and that they can have this stock now, so they're going to debit compensation expense. Actually, I'm sorry, it doesn't necessarily mean that it has to vest, right? If you're still recording it, it could still be within the vesting period. And I'll make a note of that. Sorry about that. And then you credit unearned compensation. we're allocating it pro rata over the vesting period. So we're recording this entry regardless of whether or not they are allowed to vest, but we assume sort of that's the portion of it that would be vesting if we broke it up equally. If they're allowed to expire or forfeited, you have to reverse any compensation that has not vested. And so you would debit common stock and credit paid in capital common stock. I'm sorry, debit. And this would be for the percent of shares forfeited. And then you would credit compensation expense. And then you would credit unearned compensation, if any remain. Okay, let's do a bunch of chapter 15 questions, and let's start with example 1. Okay, so basically what they want to know is Trent should recognize compensation expense for 2021 on its books in the amount of, and so what we have to do is look at it and say, okay, total compensation expense is determined to be 5,400. So we know that's total comp expense. Related to the options. The service period or vesting period equals 2 years. So expense 5,400 divided by 2 years, and you get 2,700 per year. And so that answer is C. Now you have one to practice on. Okay. See your head starting to come up. So let's look at what we've got. So total compensation equals 1,350,000. And we're going to divide that by 3 years service period. And that's 450,000 expensed per year. And so as a result of this transaction, net income decreases by 450,000. Any questions? Take a read of Norman Company, and we'll jump into it in a minute. Okay, so it's asked on January 4th, 2021, when the market price of the stock was $42 per share, all 75,000 options were exercised. What should be the amount of compensation expense recorded by Norman for the calendar year 2020? So we look and say, okay, what's our total vesting period on here? And they're exercisable via beginning January 1, 2021. So we have to count from July 1, 2018. And so I have that's 30 months. So we have 900,000 total cost divided by 30 months vesting. By 30. And so we get 30,000 per month. In 2020, there were, 112 months, right? We all remember 2020. It's still not over. There were 12 months. So 12 times 30,000 equals the $360,000. Letter B. Any questions? You have to read these carefully, especially on a test. Go slow if they look, more difficult and they're in the multiple choice section. Knock out the easy ones first and then come back to these. This is a practice one for you folks. Okay, so here they want to know what should be the amount of compensation expense recorded during, or for these options on December 31st, 2021. So we look out and say, okay, June 30th, 2021 was when they were issued. It issued 25,000 shares of its 24 for its key employees. And the total compensation expense is determined to be 100,000. And they're exercisable beginning January 1, 2023. So that's what, 18 months? Ah, find me where that is. Is that it? The service period, okay, is for 2 years beginning January 1, 2021. And so we have total cost of 100,000 divided by 2-year service period equals 50,000 per year. And so that answer is B. If they didn't have it beginning the January 1, 2021, we would have to calculate what 6 months of 18 months was, and that would probably come out to be somewhere closer to that. 33,000. Yep. Yeah, because your 2-year service period in 21, since it begins, you have a full 12 months within 2021 of that expense. Hey, now we're on the example for grant. And keep in mind that they can use treasury stock for this. This gives you a whole bunch of details, but really they just want to know, okay, we use the cost method for our treasury shares. What is the balance of treasury stock at the end of December 31, 2021? So we had 80,000 shares at $11 was the cost method. And so that's 880,000 in treasury stock. They took out 40,000 shares. And we do it at the cost method, so that's $11 per share. And so that equals 440,000 that's coming out. And so our remaining balance, I know I'd left an extra zero there, sorry. I'll fix that in a second, is 440,000. Any questions there? So we're jumping to basic earnings per share. And when we talk about earnings per share, we're thinking about only common stock. So that means we want to know, are the earnings per share available to common stockholders? That's the sort of behind the scene. And we talked about simple capital structure, only common stock or stock that does not have dilutive properties. Can't be converted to common stock. Complex capital structure. Dilutive securities. Okay, so earnings per share, the formula is net income minus your preferred dividends divided by the weighted average common shares outstanding. So keep in mind here that if preferred dividends are cumulative, even if they weren't paid or declared. Just the current years. You don't exclude, as far as I know, you don't exclude past years. Although you ask questions about things that the text doesn't always talk about and keeps me up at night. No, it's good. It's interesting. It means you're interested and it's thoughtful, but I'm like, damn, I know. So weighted average common shares outstanding is pretty straightforward. What you do is you multiply the shares outstanding by the fraction of the period they are outstanding. Stock dividends and stock splits, you'll hopefully remember, are treated as occurring at the beginning of the first period presented in the financial statements, or the beginning of the year. If multiple years are not presented. Okay, let's look at example 4. And it says, what should be Hancock's 2021 earnings per common share rounded to the nearest penny? And so it says Hancock had 50,000 share or 500,000 shares of common stock issued and outstanding, 400,000 of which had been issued and outstanding throughout the year, and 100,000 were issued on October 2021. So to create the weighted average, I like to do it this way. I take the 400,000 and I multiply it by how long it was outstanding. So I do 12 out of 12 months, which of course is 400,000. And then the 100,000, I'd multiply that by 3/12. And that equals 25,000. And you total that up, it's 425,000. Now, mathematically, the book likes to do it a little different, but it comes out the same way. The book says, I have 400,000 shares, and I'm going to multiply that by 9 divided by 12. And then 500,000 shares multiplied by 3 divided by 12. So what they do is they take the total. So if you're reading the book and you see the difference between what I do and what they do, it's really not a difference. They're just saying, okay, this total was only outstanding for 9 months. The new total of 500,000, and mathematically, I don't want to do the math in my head, so I won't, but let's go ahead and just throw it up there to show. That's 300,000. I'm always nervous when I do this. I'm like, oh man, I hope it comes out right. Divided by 12 times 3, 125,000. So. All right, now we're just making fun of me because I'm old. All right. So the book does it both ways, but you can see mathematically it works out either way. All right. But I just wanted to say, show you why you might see something different in the text. Whatever you're comfortable with, just keep in mind that you have to make sure that you get the amounts correct. Okay, so we then have, okay, net income for the year, December 31st was 1.7 million. So net income, 1700. And then we didn't have any preferred dividends in this question. So we have 1.7 million minus 0 for preferred dividends. And then we're going to divide by weighted average shares. And so that's 425,000. And so that equals 4.00 dollars per share. Now, again, I'll ask you, does that really mean anything? You can tell, well, I've got net income, that's good. I've got $4 per share, but maybe last year they had EPS of $8 per share. Maybe all the other businesses are $6 and $7 per share in that industry. So just one number in and of itself doesn't help us analyze a company. We have to look at what's the trend that's happening over the years in their income statements and also in their balance sheet and other financial statements. But one number, even hard to compare against different industries. So keep that in mind, that you kind of need somewhere to go when you start to analyze these. All right, you guys give practice number 3 a shot. Patriots are playing tonight. Yeah, stink up the field again. The Jets. I know. I keep hoping to see what's his name from the Jets actually put some balls in the air. Yeah, Aaron Rodgers. I'd like to see him go. Patriots usually have the Jets number, even when they're both bad, but no comment. I can't have thoughts as a state employee about anything. I have no thoughts about anything in Texas. All right, so it had 800,000 shares of common stock outstanding on January 1. So I'm going to go with 800,000 times 12 over 12, and that's going to be 800,000. It issued 126,000 shares on May 1. So May, June. So that's 8 months. Is that right? Yep. 8/12. I get 84,000 for that one. And then this one, they're buying back some of them. So we're actually taking some of the shares off the market. So this is going to be negative 63,000. And that was done on September 1st. So we have 4 months remaining in the year. And so 63,000. Times 4 divided by 12. 21,000 negative. And then we granted 54 or issued 54,000 shares on November 1st, which is 2 months. And so we end up with 9,000. Total goes up and it should come out to be 872,000. Any questions there? I usually try to give you the torturous ones, but I gave myself a tortured one here. All right, so jumping to example 5. And so here's where you always want to make sure you read all of them. So you don't make sure, because this issued 100% stock dividend. So it means for every share that was outstanding, they should be considered outstanding all the way at the beginning of the year. So for the first one, we had shares outstanding of 4 million. And we're going to multiply that by 2 for the stock split or stock dividend, which is technically a split. And then we'd multiply it by 12 over 12. And so we get 8 million. And we have another 640,000. We have to multiply it by the 2 stock dividend, because it's treated as though it was done at the beginning of the year or period presented. And we have 9 months on that one. January, February, March. Yep. You said 8? No, 9. Okay. And so I multiply that out, I get 960,000. then it says treasury shares purchased, so minus 240,000 times 2 stock dividend. And this was done in July, so we've got 6 months. And so that's minus 240,000. And so total weighted average shares, 8,720,000. And that would be letter C. Okay, take a minute to read through example 6. Okay, so they want to know what is our basic earnings per share rounded to the nearest penny. So EPS equals net income less preferred dividends divided by the weighted average shares outstanding. And so we have 360,000 minus, and we have to calculate our preferred dividends. $0.55 per share on common stock and $1.80 per share on the preferred stock. And so we have 20,000 shares of preferred stock. And we multiply that by 1.80. And so that's 36,000 minus 36,000. And that equals 324,000. And so we divide by shares outstanding. And so that's 200,000. It looks like 1.62 to me. Yeah. Any questions? Okay, take a read through example number 7. So here we are, fairly simple calculation. We have 960,000 net income. We're going to subtract how much was paid in dividends, 180,000. And then we're going to divide by the 300,000 shares outstanding that were the same throughout the full year. And so we end up with 2.70. Okay, so we're at the end of this handout, and I realized I didn't give a couple more challenging examples. And so I want to do a few more examples on Tuesday. So I'm going to bump your exam back. It will not be due this week. It'll be next week. I handed you out the Detroit Industries problem. And so this is going to be your in-class group work problem. And so we have 25 minutes in class. You can work on it here. I'm going to stop the video and it'll be due at the beginning of class on Tuesday. And you can either upload it or you can bring it in. If you bring it in, make sure it's nice and neat for me. And keep in mind, you can answer questions in Excel. You can just type out the answers. I know it's not as nice, but I won't be as hard on the grammar on that. And Jamie asked if you can print the handout, and yes, you can. It should be, I should have posted on there, but it is available to you. Let me just check and make sure. You guys can start talking about it. If you have any questions for me, please let me know. We just said these are 20 points. At 4 a.m. Okay, so it's out there for you, Jamie. Thanks for asking. And so this recording is done, and I will see you guys on Tuesday, or you can